Hall & Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello and welcome to our latest episode of Tax Records, the Hall & Wilcox Tax Team podcast series. My name is Frank Hinopoulos and I'm the head of our tax team here at Hall & Wilcox, and I am delighted to be your host for this episode. I'm joined today by my esteemed colleague, Bradley White, who is a senior associate in the tax team, and we will be discussing a topic very close to Bradley's heart, and that is state taxes. And Brad is a true expert in the state taxes arena and a great person at our firm. And Brad will be taking us through some issues that very commonly arise across the state tax jurisdictions, a few quirks that may come as a bit of a surprise to some of our listeners, and Brad will be explaining those, and just more broadly what to expect and what to anticipate in the state taxes area. So, Bradley, welcome. It's wonderful having you here.
Thank you for that lovely introduction, Frank. Much appreciated.
It's always a pleasure, Bradley. I've introduced the topic, Bradley. We're talking about state taxes today, and obviously state taxes encompasses lots and lots of different things, not only the rules in different states, but also different types of taxes: stamp duty, payroll tax, land tax. And overlaying all of that are some very specific state and territory. Sorry, let's not neglect our lovely territories. Some state and territory specific quirks. Bradley, talk to us a little bit about some of the trends and issues that you see day to day that are coming up in this area.
Yeah, that's a good question, Frank. I think it does.
Always good questions from me, Bradley.
Of course. As you know. Nothing but gold. It really depends on the jurisdiction that we're talking about here. So, for instance, in Victoria, we're definitely seeing most of our clients becoming, let's say, quite frustrated with land tax. And I think this is due to a combination of things. So, first, the land tax-free threshold in Victoria was lowered in 2024 from $300,000 to $50,000. So this brought a large number of taxpayers who prior to this didn't even have to worry about land tax to now having to consider it. The other thing I think as well that, at least in practice I'm seeing, is land tax, as some people might know, is assessed on the unimproved site value of the land. And so what we've seen though is usually there'd be a site valuation for the land. You'd see it in your council rates notices, and it's picked up in your land tax assessment. And that might have stayed consistent for a couple of years before the valuer general would revalue the property and you'd see the value uplift. But the frequency in which we're seeing these revaluations being undertaken has seemed to increase, and particularly around more valuable property areas, the Mornington Peninsula, some of your inner city suburbs, things like that. This more frequent revaluation, which then leads to increased site values, accompanied by the lower threshold, really has meant that land taxes suddenly become front of mind for a number of taxpayers. And that's not even just in the, I'd say, residential space. It's become a bit of a concern for some commercial landlords as well. For example, they might be locked into long-term agreements with their tenants, and all these rising costs, they might, one, be prevented from passing them on, or two, it might be impractical to pass them on because their tenant might be in a situation where those additional costs could put pressure on the business. And just one kind of final point on land tax, really, not to harp on about it too much, but if you do see a value that comes across in your land tax assessment that doesn't look right, don't sit on your hands. While for other objections, there is a discretion for the commissioner to allow themselves to consider it out of time, which is beyond the 60 days allotted, that's not the case for objections on valuations. So it's a drop dead date. Yeah, if you have an issue with an assessment, call someone like me or pretty quickly so we can see if there's any merit in trying to challenge this and take it further.
Brad. So a couple of great points that you made there. And I know we've talked about one state and one tax, Victoria and land tax. And that could probably be a 20-minute podcast podcast entirely by itself. But one thing, and I know you get lots of these questions and you do lots of this work, if somebody does get a valuation of their property for land tax purposes and they are surprised or they think it's too high and they want to challenge it, what are the options around actually challenging and objecting to a valuation? What do you do? How hard is it? And what tends to happen?
Yeah, it really depends. Your two options for the objection. First, you lodge the objection with the State Revenue Office and they will consider it. If they reject it, then your next steps are, let's say, for example, for Victoria, you go to VCAT or you can go to the Supreme Court. Those are your two options. Obviously, VCAT is the more cost-friendly jurisdiction in those instances. If you can address at the objection stage, that's what you want to do. What you'd want to back you up in those circumstances would be an independent valuation report that, supports your submissions that the value is too high. You'd look at, for example, if they've cited similar sales as a reason for the value that they've landed on, then you'd look to attack those connections and things like that. But in those circumstances where we'd be relying on, like I said, an expert valuer to provide more force to the argument, because unfortunately, the Commissioner is not going to give much weight to a submission that's just, I think this is too high, and you don't provide any kind of substantive reasoning or evidence to support that.
I started by asking you a very expansive question. And as I said, we talked about one tax in one jurisdiction. But aside from land tax and aside from Victoria, what are some of the other areas that you are seeing causing grief or causing issues for clients? I know that there's a couple of notorious areas that are constantly in the press or that we often have clients talk to us about: payroll tax, duties, etc. What are some of the other pain points or issues that you see?
I think payroll tax is certainly one. There's quite a long arm for payroll tax, with most jurisdictions having these relevant contract provisions. And if you've been paying attention to the news cycle recently, you would have seen the court has recently handed down their decision in the Uber case, which effectively reaffirms how broad of an application these relevant contract provisions have. To kind of perhaps grossly simplify it, you can be caught under these provisions effectively wherever there is the view that you have, as a contractee, provided some sort of value to the contractor. And that doesn't necessarily have to be by directly providing them services. So, for example, in the Uber decision, it was found that Uber drivers were subject to these provisions with Uber, and therefore amounts paid from Uber to them were subject to payroll tax, despite the fact that the arrangement with Uber was such that the Uber drivers themselves are the ones contracted to provide the services to their riders, and Uber was, in its own words, more or less, acting as a money kind of collection agency and deducting its fee from those funds before paying them on to the Uber driver. So that is a live issue at the moment, where a lot of people realizing there might be some historical exposure there because they didn't appreciate the breadth of these provisions. On another note, I think it is more generally the kind of self-reporting type duties and taxes that are catching out a lot of people, because people aren't necessarily aware of them. So landholder duty is a big one as well, where you are acquiring interests in, such as shares or units in a unit trust, in those entities that hold property or have indirect interests in property through a chain of entities. You can find yourself effectively, if certain thresholds of interest are exceeded, you need to make lodgements with the revenue authorities and pay tax, pay duty. There's been some issues in practice where you might even have a change in shareholding happening in an overseas company, but that company might have a local Australian subsidiary that holds land, and you have to explain to some people very unfamiliar with the Australian jurisdiction that they have to pay Victorian tax on their foreign shareholding exchange. So it's definitely one that does catch a few people out.
Brad, one thing that I find, and this is especially the case when we're involved in a business or an asset sale or a share sale, is, and again, this often takes clients by surprise, is to tell them that there is sometimes duty applicable to business sales or in a sale of business context. Can you elaborate a little bit about that and help explain to our audience when that might be an issue?
Yeah, of course. And you're right. It's definitely somewhat of an unpleasant surprise for a few clients, or hopefully not a surprise because they've spoken to us before they've sought to implement any kind of agreements. But you're right. In Queensland and Western Australia, they still charge duty on the transfer of business assets. So you can, if you are looking to undertake the purchase of a business in those jurisdictions and it's by way of asset sale, then you need to consider whether or not duty is payable in those jurisdictions. And one of the things that really catches a lot of people out is that business assets include goodwill. And so effectively, if the business that you're acquiring has generated or received income from customers in those jurisdictions, WA and Queensland, at all over the past 3 years, it can fall within the regime and be subject to paying duty on the goodwill it may have acquired. Practically, what they do to determine that is if you have a valuation, or they might look at the net asset position of the business to see what the good value of the total goodwill might be. And then they'll look at your financial statements and income sources for the preceding 3 years. And to the extent that your sales come from those jurisdictions, they'll seek to apportion that value of your total goodwill to those jurisdictions. A simple example, goodwill of $1 million, 10% of your sales over the past 3 years came from Queensland. You're paying duty on $100,000 of that goodwill value in Queensland, as a quick example. So it's definitely something to keep in mind. And just building on that, there's this broader duty base of assets in Queensland and WA generally. And it's quite important to keep that in mind, particularly in Queensland, where not only is there this broader duty base, but they have a different kind of duty called trust acquisition duty. And so that's effectively wherever you acquire an interest in a trust and there's no minimum threshold, you pay duty on the proportionate interest in the underlying dutiable assets that you acquired. So now, given that their dutiable assets include business assets and chattels, it basically, if there are assets in a trust and those assets are in Queensland, you need to be pretty careful.
Yeah, thanks, Brad. Like I say, it's often an unpleasant conversation and it takes people by surprise because it's one of the duties we don't have in Victoria is duty on business assets or business goodwill. But it's, as you said, in Queensland and WA, and it can sneak its way into a lot of transactions because of this, because of your sales in Queensland or WA, enlivening the jurisdiction in those states to apply duties. It's a really important issue, and I think what I'm hearing from you and a couple of the themes are basically any transaction or even any interaction which involves land may have a duty element or a duty consideration arising. So be sure that you're covering it. And indeed, any interaction or transaction involving business assets, even intangible ones like goodwill, may also have a duty implication. Make sure that we're keeping clients informed.
That's right. And not to add more kind of fear out there as well, but there's also an additional consideration when dealing with fixtures as well. Victoria, for example, when you're seeking to transfer fixtures separate from land over a certain value threshold, then you can also fall within the duty provisions as well and be charged duty on those fixtures separately. And then the value of fixtures as well is also taken into account for landholder duty purposes. And what amounts to a fixture in those cases is broader than the common law view and basically can extend to include anything that's more than tenuously connected to the land. Again, sometimes an unwelcome surprise where you realize that you thought you were just paying duty on the building, but then you got to add in all the value of the plant and equipment. But definitely something to keep in mind.
Yes, we're not here to fearmonger, Bradley, but unfortunately,
educate,
some of the quirks.
Educate.
Yes, we're here to well put. We're here to educate, but obviously some of these quirks that you've talked about and some of this very expansive application of these duty provisions is something to fear, and it is something to fear because it can be easily missed. and it can apply in ways that might be counterintuitive or that clients may not expect. Now, Bradley, you and I are in Victoria. We're proud Victorians. I'm sure a lot of our listeners will be in Victoria as well, although not all of them. One great thing about tax records is that we do get a national audience. But let's take things back to Victoria, because I know that there are a few unique taxes to this jurisdiction. Aside from what we've already talked about, are there a couple of others that maybe you can expand on and talk more about? And I know what I'm thinking about is some of our taxes in Victoria that aren't necessarily, there are equivalents in other states as well, but that might apply to people offshore or foreign residents and so on and so forth, because we get lots of questions about those.
Yeah, there are a few unique Victorian taxes, and for those listeners not based in Victoria, I think it's still important to be aware of what these are, because history shows that the other states and territories have a proclivity to pick up some of the extra Victorian additions. A recent example is those foreign surcharges for foreign purchases of residential property, as well as foreign land tax surcharges. I believe those were first introduced in Victoria and have now been picked up by, I think, all state and territories now, as well as an even more recent example. New South Wales has aligned their corporate reconstruction concession and landholding thresholds to those of Victoria more recently. Just because they're Victorian specific for now doesn't mean they always will remain. I think the main one that is causing a few headaches for people is another land-based one. It's the vacant residential land tax. And to your point, Frank, this impacts people based overseas, as well as people who just simply have beach houses and investment properties that they like to leave vacant so that they're available for their use or for their family members' use. Broadly speaking, this tax, where a property is vacant and unoccupied for 6 or more months in a year, you can fall afoul of this tax. And it's a 1%, it starts as a 1% tax on the capital improved value of the land, distinct from site value, so it's a higher value. And then each successive year that it's vacant, it increases by 1% up to a maximum of 3%. So on $1 million house, you're suddenly staring down the barrel of a $30,000 a year vacant residential land tax assessment. And this is in addition to land tax. This is really driven at, the policy decision behind it is to get people to stop parking homes as a form of investment that aren't being utilized. They want to ensure that these houses are available for renters, given the current issues with housing affordability and housing availability generally. So that is something to be aware of. Effectively, investing in an investment property in Victoria is becoming less and less desirable given some of these taxes. There are certain exemptions and concessions available for example, houses that are used as holiday homes, subject to certain, like I said, certain requirements being met. But one thing to note, though, is that that exemption doesn't apply to newly acquired homes that are held in a trust. So if you are looking to buy a holiday home, it'd be worthwhile considering whether or not you want to put it in a trust, or if you're looking to rely on this exemption, whether or not it might be better to have it in your own name. That's vacant residential land tax. Another Victorian specific one, I don't know how many of the listeners here are related to the development field, but is the windfall gains tax. This has been around now for a couple of years, but it is a very big tax impost, so it's probably important to flag it. Effectively, if you have property that's rezoned and the value uplift from that rezoning is more than $500,000, half of that uplift is subject to tax by the Victorian government. Now you're able to defer that tax for, I believe it's 30 years and pay it off, once the property is sold. But during that deferral period, tax interest is applied as well. And as you can imagine, if you're rezoning Greenacre land into a commercial development, the amount of some of this uplifts is pretty significant. And it's be aware. And if you are being approached by developers, say if you're in rural areas and they're looking to acquire your land, make sure it's very clear on who has the burden of paying that liability. And so therefore be clear on whether or not the sale is supposed to occur before or after rezoning is a critical component on that one. And lastly, I think is the commercial industrial property tax in Victoria as well. This is basically Victoria's approach to stepping away from charging transfer duty on the sale of commercial industrial property and moving to an annual tax. How it works at the moment is effectively if you acquire commercial industrial property post 1 July 2024 for the first time, you still have to pay duty, unfortunately. But then 10 years later, down the track, you also have to start paying a 1% annual tax based on the site value of the property called the commercial industrial property tax. But after that first acquisition, post 1 July 2024, any subsequent transfer of that property is free from duty. Frank, if you bought yourself, say, an ice cream factory on 2nd of July 2024, then...
I may well be eating all of my profits if I did that, Bradley, so may not be an astute financial decision, but carry on.
Well, you got to go into business doing something you love, Frank.
Ice cream, yeah.
So you bought that on the 2nd of July, and maybe you decided that you can't hold on to this business because of the allure of all that free ice cream. So you decided to sell it off to me, who is equally gluttonous. I wouldn't have to pay any duty on that acquisition because you've already paid it and opted it into the new regime. And so as the second purchaser post 1 July of that property, I don't have to pay any duty. I still would be on the hook for the annual tax, and that would be 10 years after you had acquired it first. So 10 years after it had been opted into the regime, effectively.
You found the ice cream factory loophole, Bradley, I think is what you're saying. But Brad, I could listen to you talk for hours on this. And so thank you very much, as always. And yeah, I hope we haven't completely petrified our audience into inaction. But all of these things with careful management, with careful planning, and by speaking to an expert like you, are things that can be navigated. Thanks very much for your time, and thanks to everybody for listening today. As always, please get in touch with us and one of our tax experts if you have any questions. You can find all of our details on our website, which is Hall and Wilcox, hallandwilcox.com.au, or connect with us on LinkedIn. And if you enjoyed today's episode, and I have no doubt that you did, then please rate, review, or subscribe wherever you get your podcasts. Thank you very much.
Thank you.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.